Okay, guys, thank you so much for joining me for this special webinar. We're not supposed to do this on YouTube. Instead, we're supposed to do it on GoToWebinar. But I received countless of error messages in the last half an hour. It's just been pure agony as I was trying to log in. So sorry, guys, to keep you waiting. I'm gonna make sure that it's worthwhile for you though to stick around here and listen to me over the next half an hour to maybe an hour. Really depends on how many questions you have. Okay, good. All right, so you can see me. You're not supposed to see me either, but here we are. Thanks so much for joining me, and I hope you're doing good. All right, so we're going to talk a bit about how to trade the Corona crisis and how to do that safely. There's a lot of people that are interested in trading, and a lot of people that actually get involved in trading right now, looking at those big swings in the markets, and they're thinking, I want some of that. However, if you just open up positions nowadays, you can easily see your account being up with a lot of money or losing a lot of money. And the way that humans are hardwired, really, it's a situation where many times we're just hardwired to lose, unfortunately. And we're going to talk a bit about how we can try to minimize that. Of course, I'm not going to be able to sort of give you everything in half an hour, up to an hour, but I can give you a little bit of an introduction to what to look out for, what to pay attention to. And from there, if you want to have more educational stuff, or you can just explore things on your own. Okay, good. So we're going to begin. And before we begin, as always, I want to just point out that trading financial markets, unfortunately, is high risk. A lot of people out there, especially on Instagram and so on and so on, try to make it like it's super easy, that people are, easily just having buying themselves a new Lamborghini or new Ferrari, and life is very easy. You can trade from the beach and things like that. Unfortunately, it's not like that. Most professional traders, unfortunately, they don't have that luxury, and also they love it so much, so they want to have their special screens and everything set up. So that there tend to be people that don't necessarily will be trained from the beach. It wouldn't really make sense, to be honest. So please bear in mind, we can lose our money invested, and 67.67% of people that trade with ATFX lose money. As well, we're doing this with an educational purpose. I'm going to try to guide you to the best of my abilities. But unfortunately, because we're dealing with random markets sometimes, there's fortunately nothing I can guarantee you. If you're looking for something guaranteed, then investing in treasuries or putting your money in your bank account or something like that would probably be better. Okay, good. So why should you spend the next half an hour to maybe 1 hour with me then? Oh, and who am I? So my name is Alejandro Zambrano. That's me here in the picture. And I lead the team at the site called investingcube.com, which is a site I created for ATFX. And ATFX is an FCA regulated broker. They're based in Cornhill, 32 Cornhill to be exact. If you guys know London, it's we pretty much in the corner where you have the Royal Exchange and the Bank of England. Not on that side, but we can see the Royal Exchange, and you have the Louis Vuitton shop just next to the we're facing it just to the right there. So very, very central location in London, and they're regulated in the UK, and they have offices in many different parts of the world, sister companies essentially that use the same brand. Okay, so I'm with them. Before them, I was the Chief Market Strategist at a company called Amana Capital. They're also FCA regulated, and they are one of the bigger brokers in the Middle East. And you might not know about them, but you probably know about FXCM and Daily FX. So I used to work for FXCM and Daily FX from 2009 to 2016. And I learned a great deal over there because I spent a lot of time there, and they used to be the biggest broker in the currency markets at that time. And you meet a lot of people, you meet a lot of traders, and you get a very, very good view on what works and doesn't work. And we had access as well to proprietary data, anonymous, of course, to try to help our clients understand the markets better. But since February 2019, I am with ATFX. Okay, good. So why should you pay attention to me then? Well, I've been trading since 2006, and I started out different strategies, short-term trading primarily. I started with about 2,000 euros in 2006. And from there, I tried to understand the markets. I was doing a lot of silly mistakes. I did some silly mistakes for I think about 2 years, something I just realized afterwards. And I pretty much traded many different strategies, long-term, short-term, and I found something that worked for me. And I've been profitable since 2014. So hopefully I can share some of that insights with you guys. Okay, good. Okay, so I'm just gonna close down the other webinar now. Okay, good. So what are we going to talk about today? So we're going to talk about the Shanghai Composite and its reaction to the 2020 coronavirus crisis. We're also going to talk about the market reaction to the 2003 SARS virus crisis. I read up on both the SARS and I witnessed this one live, the 2021, and I used that information to get an understanding of what could happen with the Dow Jones and the DAX in 2020. And for me, it was rather predictable if you knew these two things. And I think it's working out very good for now. And when I try to talk a little bit what happens on the other side. And so we're going to talk about that. We're going to talk about trade management. Because again, you know, it's not enough for me telling you guys what to be looking out for. It's more as well about how to manage that, because there's always an element of uncertainty when it comes down to trading, an element where we don't know what's going to happen next. And frankly, no one knows. No human, at least, knows what's going to happen. We might have our models and everything, but at the end, there's always a risk that we can end up losing money. It's a little bit like the car seats belts, right? We use them. We don't think we're going to have an accident, because otherwise we wouldn't be getting into a car, but you never know. And that's why we use a car seat. And that's why we use stop loss orders. So we're going to talk about trends, stops, take profits, and how much to risk per trade. Those are very important combinations. And many times I don't care about all the noise that is happening, what they're saying on CNBC, what they say on Bloomberg, what people are saying on Twitter, what people are saying in newspapers and so on and so on. Because I know no one really knows exactly what's going to happen, but I definitely know where I'm going to be getting into the market. I also know as well where I'm going to be getting out in case of profit and in case of loss. And I'm going to try to share some bits and pieces of information about how that works to you. When we cover that, we're going to go through live what happened with the DAX and what happened with the Dow Jones in 2020 when the market started to trade to the downside. Let's begin with what happened with the coronavirus 2019, that's what it's called, and how it emerged in China. So this is the Shanghai Composite. The Shanghai Composite took pretty much the most amount of beating this time around. In the 2003 SARS epidemic, it was actually the Hong Kong Stock Exchange that took the most amount of beating, even though, if I remember correctly, the number of people dead in China and in Hong Kong were pretty much the same. But in Hong Kong, things were, the focus was more there, and people took seriously the shutdowns over there, and that created the very strong declines in the Hong Kong stock market. And I'll show you that in a few minutes. But look at this. When this first started, and this is in January. So in January here, January 20th to be specific, they had 278 cases of the new composite, of the new virus. And this analysis, which was actually produced by one of my colleagues, her technical analysis indicated that we're probably going to continue to go upwards. But we know very well what happened afterwards. And what happened afterwards is that the Shanghai on the 21st dropped, because the number of cases had increased from 278 to 326. So that is 326 over 278. That's a growth rate of 17%. And people started selling on the back of that. On January 22nd, so just a few days later, the number of cases had increased with 547 in just a few days. So let's take a look here. What's the growth rate here over 2 days? 547 over the base, which was 278. 278. That over those 2 days was a growth rate of 96%. If we if we raise this by half 0.5 to account for the 2 days, then the growth rate was 40% per day on average, the geometric return over these 2 days. And that is what alerted me when I saw this. And also I was in Hong Kong around the same time here, and that also scared me. Long story short, I was looking at the numbers and seeing how this was increasing, and given that I'm a trader and an investor, I know very well how compound interest rates works. So looking at this, I was doing some simple calculations, like take 40% return, raise that by 14 days, and you get a factor of 114. You multiply that with 547 cases, then you will get 65 cases after 14 days. It wasn't really that amount of cases we saw after 14 days, but you can see how the growth rate expanded. And the key point here is that when very few people knew about it, and people were looking at these growth rates and they remember what happened in 2003, that's when people started selling. When I came back from Hong Kong, my wife didn't really care or understand what I was talking about and why I was worried. She went to France, and things were going a bit crazy over there. And I told her, actually, you should probably stay with your parents, because we live in a London flat. It's a 3-bedroom flat, very central, but it's a flat. Her parents have a house with a big garden, and I have a little toddler or a little baby, 2 years old. I told her, you should probably stay in France. She didn't take me seriously. At ATFX, we had one of the members that went to Italy, and he came back on a Sunday. On Monday, they shut down Italy. And I was telling him, I know you're going to the south, but you're going to Italy. And if you just look at the numbers here, it's just going crazy. And as well, we had 2 other members from ATFX. They went to Spain. And I told them as well, look, do you really have to go and visit your parents this weekend? Have you seen at the numbers? People just left. Because at that point, people had no idea how this could influence. And people didn't really bother to look into. But the smart money, they're looking at growth rates, and they try to look at the growth rates to try to predict what's going to happen in the longer run. So what happened here is quite interesting. The daily growth rate in this increased and increased and increased, and we had more and more cases. And eventually, on the 23rd, they closed for the Chinese New Year. They were going to close anyway, but they closed for the Chinese New Year. And then on February 3rd, they opened again. And I don't remember exactly when they closed down Wuhan. Actually, they closed down Wuhan, I think, already on the 22nd or so, or 23rd. I think they closed down Wuhan. And then what happened here, the market had a massive gap, a decline of about 7.65%. And then on that day as well, the Central Bank of China pumped a lot of money into the system. And then after that, the market moved upwards. And why is this interesting? Well, because, let's see if I can make this a bit bigger for you. But what's happening here is that on February 26th, the growth rate, which was close to, as you can see in the very beginning, close to 40% per day, that growth rate had declined to 11% by February 6th. And what's quite interesting is that the market moved up higher, and the day afterwards, that's when we saw the actual decline in the growth rate. Why? Because I reckon you have people on the ground and people that are willing to take a contrarian bet sometimes, and they were probably saying, okay, this is probably as bad as it's gonna get, and then they decided to buy. And then this market actually did go up quite a bit and closed most of the gap. But what happened afterwards, that we had the second leg of the spread, and that second leg of the spread happened, of course, in Europe, and it started with Italy. So what can we learn from that episode? Well, what's important here is the growth rate, because markets are forward looking. They look at their companies today and they try to say, okay, this company is making $100 million per year. How is this coronavirus going to influence? Well, this company is not going to be making 100 million over the next 3 years, so a total of 300 million. Maybe it's going to make 250 million over 3 years. So then they need to adjust their prices. That's sort of how you can look at it. And for people in this virus, the growth rate was important because people sold when the things were kicking off, and when they anticipated the slowdown to decline, that is when they bought. What happened in 2003 then? Very, very, very similar situation. So this is a bit of a different chart, a little bit difficult to understand, but the blue histograms shows you how many new cases per day we had. And you can see here that in March 2017, that's when the chart starts, and then it continues over this point here is June. And you can see how we had quite a lot of cases increasing. These are cases, probable cases worldwide. Thing pushed up, pushed up, pushed up. And then you can see here that around March 28th, you had that spike. And then after that, we had less and less cases. And then here in May, we had that final push, but that push was lower than the prior push. And then the market settled as people were doing good enough work to make this virus stop infecting new people. So around 28th of April and the beginning of May, that's when this peaked. What happened with the actual market then? Well, 28th of April, where you can see that yellow line, that's when the blue line, which is the Hang Seng, that's the Hong Kong stock market, was at its lowest. From the initial level here, from March, we were down with about 7.5%. The orange line is the Japanese stock market, which followed the Hang Seng very well. The purple line is the Shanghai Stock Composite. The Shanghai Stock Composite was in a bit of its own world here, so it wasn't really moving too much in line with what was happening in the coronavirus cases. So what's interesting, as per this chart, when we had the highest amount of cases, that is when the stock market bottomed out, and then the market went from -7% to roughly by June here it was up with +5, and then eventually went up at +10, so about a 17% percentage points difference, more or less. And this is quite interesting. So you have the World Health Organization pushing a bit for issuing a global alert. And then here, they start to have emergency meetings for SARS. And it's when the government starts to take action that this bottoms out. And we've seen something interesting now as well. It's when the governments started to lock down that we saw the beginning of the end of the virus spread. So by the time, see, the World Health Organization as well, they said, all right, they didn't want to lift the travel warning for Hong Kong and China. And eventually, when they announced that the world would soon be SARS-free, the market had already risen. So we can't follow the recommendations for the World Health Organization when we're trading. You can use them, but not in the way they're supposed to be used, which is that you can't sell when they tell you that there's panic and the house is burning, because the house is already burning. You need to get out of the house before things start burn down to the ground. And there's no point waiting for them as well to say, oh, it's all clear now, because at that time, the market has already moved ahead of us. And this same pattern repeating itself this time around as well. Now, we're going to talk a little bit about trends. So you know now that what we saw in China in this year was pretty much the same pattern we saw in 2003. Now, then what happened this year around is also pretty much the same. But we're going to try to take that information and make it into something actionable. And that's why I'm going to show you a little bit about trends. The benefit of trends, and you can make it more sophisticated. You can always add a few more sort of, you can add a few patterns if you want to. You can spice it up with some Fibonacci, whatever you want to do. But at its basic, price action and trends is what dominates, and you can use that to your advantage, and at least that's what I do when I trade. So we're going to talk about downtrends for now primarily. So for me, this is price, and we're just dealing with a downtrend where the market started up here, went down to point A, and then rose to point B, and then rose to point C, declined to point C. What this tells us, and it's two interesting things. This low is lower than this. This high is lower than this high. And this low is lower than this low. Because of the definition of a downtrend, we can assume, when we're trading here, we can assume that the price should not trade over point B, and we can also assume that we are going to break below point C. That's just a basic assumption of trends. Does it always work? No, not always, but you definitely have short-term trends from a few hours to a few days to even longer. And the markets tend to trend, and sometimes they trend like crazy. Can I give you some recent examples then? Well, Bitcoin, right? Bitcoin was around 1,000 or so in 2016, 17, and then I think it rose to about 19,000. Crude oil prices at the beginning of this year reached a high, I think around 60, 70, or we're trading at around 60, 70 before the crash. And what happened then? Well, you had that crash from about 50, 60 all the way down to 19. Now that's a crash. Stock markets as well, they were up with about 10%, and then from the very high to the very low, they gave up some 35 to 40%, depending on which market you're looking at. What else? Gold. Gold has been in a massive trend since the last 2-3 years, and it's approaching 2,000 soon. Like summer last year, we were not trading at all at these levels. So you have trends, and I try to use them to my advantage. And as well, if you think about it like this, people out there that are more clever than me, they possess more money than me, and maybe they have a full room with very clever people. If they really like something, they're gonna leave footprints, they're gonna leave marks on in the charts, and that's they're effectively disclosing to me what they're doing by carving out trends. So I rather piggyback on those people than myself trying to figure out, when the trend is going to reverse and so on and so on. Now, I don't always apply that because there's always need to think about the long term and the short term. But in the short term, most of the time, I always go with the trend. So this is the downtrend. Okay, so just to reiterate here then, we're creating lower and lower lows and lower and lower highs. As long as this is true, we're in a downtrend. And by that simple definition, we can sell here with a stop here. The key point that you need to figure out is which is the important high and which is the important low, depending if it's in an uptrend. As well, if we sell here and we put our stop loss on the other side, then we can assume that this is going to go down. Now, this is very, very good. And I'm going to show you some real examples what happened this year with the Dow Jones and the DAX. And this is good because we might be trading at this point here and the Dow might be going down, and you want to put a stop loss up here because you think, for example, that the cases are they're gonna increase more and more, there's gonna be more chaos in the world. But you never know for certain. But you know for certain that if you sell something to make money on it to decline, then you know for certain that if you sell here and you put your stop loss here, then you know for certain that this is gonna be your max loss. And that is something you can control. You can't control what's going to happen with the cases in the world or how everybody else is going to interpret the trend, but you can control what's going to happen if things don't go your way. And that's really important. And a lot of people don't do that. They just buy and they just sell. To give you a good idea, my brother-in-law, when the market was just declining and declining, he texted my wife and said like, oh, can you ask Alex? I just bought a few options. So he was buying a few options for the market to continue to slide. Yes, we're dealing with a downtrend, but you can't blindly just buy and sell. And he thankfully we talked them out of it, because as you know, since pretty much March, the markets have risen quite significantly. All right, let's continue with the next slide. Here's another and very funny looking one. You can see how the market is going down, up, and down. So you know two things for certain. You know that high is lower than this high. And just we can clearly see as well that we were going down before this happened. So you can have an indication here, like even if this low is higher than this low, in a downtrend, as long as we're creating lower and lower highs, then we are in a downtrend. And that's really important to remember. So while the definition says you need to have two lower lows and two lower highs, when you can easily see if we're going down, what's important is how the series of lower and lower highs. So as long as we create these lower and lower highs, we're going to be in a downtrend. The next shows you just an uptrend, and you can see the price went to A, and then to B, and then to C, and then to D. So when we're trading here, with no doubt can you say that we're dealing with the uptrend. And you can say, well, this is an interesting low, and that will be my trend defining level. So if you would like to buy here, you would probably put your stop loss down here. And the difference between that entry and that stop loss would be your risk. This is very simplified. I'll explain a bit more how we can do this in a better way. Now you know a little bit about trends. So let's take a look now what actually happened with the markets. Okay, so let's begin with we're gonna begin with the Dow Jones. As well, if you do have any questions, you can just pop them in the chat box, and I'm gonna address them. Okay, so let's begin with the Dow. Let's begin with a fresh chart. All right, so this is the Dow Jones. So on the way up, everybody was very happy, in a happy mode. The market was, after trading sideways here from 2018 up until 2019, the market finally turned bullish, and it was heading up and up. And it was nothing bad to try to trade with this. And we're gonna flip to a 6-hour chart. And you can see how the market is creating higher and higher lows. Now sometimes what happens is that you have short-term trends like this one, where the market just goes up and up. And then once in a while you have a slightly stronger pullback that shakes out everybody trading the short-term trend, but then we continue to go up and up and up. And then again you have a little bit of a shakedown, and then we go up and up and up. And then we have a stronger push that shakes out more people trading the short-term. And what's also interesting here is that if you look at it, we were here in February 2020, and we had previously been here in December. So pretty much it's like 2 months of data. No, sorry, 1 month, 1 month and 2 weeks. So you can see how the move to the upside is starting to slow. But the market went up, and then it went down, and then it went up, and you could have pushed up and tried to trade the short-term trend as long as possible. So if I remember correctly, I was bullish because I do a daily market webinar. So if you actually check out this YouTube channel, I do it one every day. And you can see, and I remember very well that either I got stopped out here or here. But from this point onwards, the market has stopped creating higher and higher lows. So independently of what I thought was going to happen, I was forced to turn bearish at that point. And then the market started to create lower and lower highs. So we're going to keep it simple. We're not going to go too much into the finer details, but imagine this, the market goes down. So the first thing you see when the market goes down aggressively like that, you're going to try to put some Fibonacci. Fibonacci is quite straightforward. You draw it from like the maximum level, and then you draw it to the minimum. And it depends, of course, but this is a down move. So for example, if you're looking at this and you say, okay, this was a down leg, and we have this virus ripping a hole in the fabric of our society and forcing everybody to stay home, then one could have argued that probably the problems would not be over very quickly. and we could probably been a bit bearish. So you could have taken fib from this high to this low, and you get these different levels here. So there are different ways of looking at this, but one way of looking at this is that this is the last major high, right? And that could have been your stop level, but you probably would not have put it there, because you would have said, okay, you have all these Fibonacci levels. You got the 38.2, you got the 50, you got the 51, 61.8. And if this is a genuine downtrend, then most of the time we will not trade above the 61.8. And we're definitely not going to go all the way up. You can look at it from the following perspective, okay? Imagine that you want to, your favorite product, so you got price here, sorry, you got price here, and you have time here. So this is your favorite product. This is costing $100, and then you say like, oh, I want to buy it, but I don't want to buy it now. So you're gonna buy it at 50, okay? Or so you buy it at 80. You got a discount now. You say, okay, this is interesting. That new product is supposed to help clean my carpets really well, and it's really cheap now. And then it goes down even further, and now they're selling it for 20, and then it comes down and they sell it to you for 10. Then suddenly you start to say, hold on, it used to cost me 100, now I can buy it for 10, or I can buy it for 20. Is there something here I don't know? And then you go online and you see that while it will leave your carpets clean, it will also ruin the fabric of your carpets. So what's going to happen is that the longevity, or the lifespan of your carpet is going to be reduced significantly, and that's why they're selling it very cheaply. So really good stuff don't go back 100%, and that's the same thing here. This slides because the idea is that the virus is going to give us a lot of problems. But if this slides a lot and then goes all the way up, then that just tells you that people are not trusting, people don't believe in that idea. So we don't necessarily have to put the stop loss up here. I would probably just put it maybe somewhere here, just above the 61.8. Now here is what we call selling the correction. So you would probably have sold, you wouldn't necessarily have sold the first time. Maybe it went aggressively up and then it came down a bit and then it came up again. So it came up here and you have what we call a double top, but you don't know you're going to have a double top until the price is done here. But say for example, you sold here around that 50 level with a stop loss up here. And surely in the very short term, you had a bit of an uptrend, right? But when the uptrend here took out this low, then this was not the last major low and high anymore. This level here was now the next major low, next major high. And there are different ways of dealing with profits here. One would have been just to sell here and look for the low. Okay, that would have been straightforward. And other people will do as well, because you had your stop loss up here. You would probably have maybe shorten up here somewhere. Your stop loss was up here, so this would have been your risk. So you would have risked 3%, and if we go down to the low, you would have made 8.4%. So you would have made 2.79 times your risk, and that's what we call a good risk-reward ratio. A decent risk-reward ratio in general is 1.5 up to 2. When you're trading such a longer term like we're doing here, then you can go for 2.5, sometimes 3. If you're trading very short term from a few hours or so, then you're looking at maybe a 1 to 1. But that would have been something. And then the market slid down, took out that new high, a low, went all the way down, and then it went up. But this time around, we did not go, I mean, actually we went up to 50, we just went up to the 38.2% level. Now, I would not necessarily have sold here, but one thing that could have been done is to sell the break to the downside. And what happens when this goes down is that this now becomes the next major high. And now this becomes the trend defining level that we should be focusing on. And if you don't sell the correction, sometimes you can sell the breakdown, because there's effectively two ways of trading a trend. One is, as I just mentioned, if you're in a downtrend like this, when we trade below the prior low, that is selling a breakdown. So that's the breakdown. The alternative is that when we go up again, we have what we call a correction. You sell the retracement, which will be here. So there's two ways of trading the trend. And how do you figure that out, that retracement? Well, you can look at prior lows and other support or resistance level. You can also put the Fibonacci, and the general idea is to sell the retracement with stop loss at a significant high, or if you did like we just did, you put your fibs. So maybe this was your 50 level, and then this was your 61.8, and then you would say, I won't actually put it here, I put my stop loss here somewhere. And then we had the break, and then obviously it wasn't easy. If I remember correctly, I was bearish here and here and here, and then because in the daily morning update that I do, I look at things much more short term. So if I remember correctly, I was focusing on this little point here, and I do remember that we went all the way up, and the bearish traders, the bearish view got stopped out, but then eventually we just went down, and then went up, and then went down, and then went up. But then at one point, the market actually flipped and turned bullish. And this is quite interesting. So the market bottomed out on March 2003, March 23. And if you look at my Excel sheets for the latest developments in COVID, you will see that the highest level of cases in the US was on March 19. Let me see here. Is this one? So these are just countries, and we want to look at the US. So on March 19, you see the time here, March 19. In the US, the daily growth change was 51%. The day before, it was 47. And what happened at this specific point is that California decided to shut down. And that was when the US had 4,800 cases. When the US had 8,459 cases on March 22nd, and the growth rate was 32% that day, that's when New York decided to lock down. What's quite interesting is that the German DAX on March 19th had a growth rate of 71. And they locked down the day afterwards on March 20th. What I did is that I took countries like Italy, France, UK, USA, Spain, and Germany, and I created my own index of their growth rates. And I created a nice little chart of this. And this is a chart I was using almost every day now with the guys when I do my webinar. And you can see here that on March 19th, the growth rate for across all these different countries was at a high of 35%. And since then, the growth rate dropped sharply, and it's been dropping and dropping ever since. And the markets have not looked back, have they? No. Why? Because investors now predict that times are going to be better ahead. You might say, hold on, industrial production was out yesterday, and it was the worst number since 1946. You're right. As well, retail sales, I think it dropped to levels we haven't seen for like 10 years. The only thing people bought was like toilet paper. So I don't disagree with that, but all of that data, from which period was it? Oh, it was March. And we all know how the market was just declining and declining and declining and declining in February and in March, and no one could give you a straight answer. I mean, I was telling people it's the virus, but I had no idea that the data was going to be so bad. But it was. And if we think about it, it's all natural. Why did this happen? It's not because we have a systematic crisis in one of the banks or one of the industries. The only reason why we have this shutdown is just because the presidents of the world and the governments of the world told their people to stay home. Simple as that. So suddenly you have a whole sector like the restaurants, and they just have to shut down. So of course they're gonna make zero sales. All their staff is gonna lose their jobs, and that's why. And it's happening at the same time. So what's gonna happen when they open up the economy? It's not gonna go all the way back, because that does not make sense, because they're gonna take it in steps. But if you look at the SARS crash since 2003, eventually we did sort it out. And if we just follow these steps, I think realistically at one point we're gonna be back to normal. So maybe in 2 years from now we're gonna be normal. So of course, when we're at the rock bottom there, no one wants to buy a new Ford car. Nobody wants to go on an air flight with Lufthansa, and nobody wants to go and buy expensive clothing, the luxury brands. In fact, you can't even go because you need to buy them online. And you do want to buy them, but because the factory is closed, you can't buy them because they don't have availability. But come 2 years from now, and people will be buying the latest iPhone, people will be buying those very expensive shoes, people will be buying themselves a car. And that is why people as well bought at the bottom here, because a little virus is no match for humans. That's my point of view. I think we're very clever in that way, and we're gonna do whatever we can to get it out right and come out ahead. So what could happen here then? So what happened effectively? It would have been perfectly fine to sell either on corrections, breakdowns. You would have been stopped out here maybe if you did sell somewhere here, and then the market went down, and then maybe you sold a bit here, then the market slid, and then maybe you sold a bit here, and then it went down. And then if you did try to sell here, you would have been stopped out. But when we cross this line, and if you had access to the data, you could see that we're not seeing more cases, then you would have known that we're probably going to start to do this. And that's exactly what we did. So now we're going upwards. So there are a few levels we can watch. This one sticks out. So this level here sticks out to me. So in the Dow Jones, I am bullish above 22,332. And my original idea was to buy down here, but it looks like if I settle here, I might change my mind over the next few days. But for now, I'm going to continue to be bullish, and I want to be bullish around 22,904. But if we take this out, when we took out the low, the market's going to seek itself to the next low. So we take this out, we go maybe a little bit lower. In the case of the German DAX, we are already at a very, very at an interesting level, where the market went all the way up, and then we're very close to that low. Now, just because we take out that low, and that low is 10,083, it doesn't mean that we're gonna have a major reversal in the market. But I do think if we take out this webinar, not this webinar, but this level here, we might actually trade a little bit lower to 97.58, and then maybe we'll go all the way down to 93.15. But remember what I said before, you always have the short-term trends, and what happens is that you have those shakeouts. It shakes out all the short-term traders, and then what happens is that you have this other trend here, this level here. Then there's a bunch of other systems and ways of trying to figure things out. If we're gonna go down, some people have done wedges and stuff like this, but personally I don't trust wedges too much. But people do this, and this is a bearish pattern, and if you're super bearish, then yeah, you would probably sell on 10,083. So where I put my stop loss to get out, because we're losing money on the long, some people are probably going to be selling, and they put the stop loss orders here. And then the difference between these 2 points would be your profit target level. And if we take out that level, we might go all the way down here. Would it surprise me if we go all the way down there then? It wouldn't surprise me, but it's not my main view and my main way of trading. Because as I said before, I'm an optimistic person. Governments, they are showering us with money. I've spoken with 3 people that are not working because of this crisis. they're very happy people. One guy, he works for a Volvo company, like Volvo trucks. Because they don't have spare parts since February, he just been at home, full paid. This is not in the UK, by the way, this is in Sweden. So what happens here is that he's getting full paid, and if something happens, they're going to, he's gonna get money from the government. But they already started to open. I think Volvo Car started to open up. My own sister, she works in hospitality, and she was working at a hotel, and she got made redundant, but she's getting paid for 6 months. Again, this is Sweden. So for 6 months, she don't have to do nothing. She's just at home. And when they open up, what they surely will do, because of the rules over there, you can't just hire fresh people. You need to hire the same people you had before. And depending on your seniority, you can actually, you will come out ahead. Are they gonna hire back, just to give it very simple, are they gonna hire back 100 people that work at the hotel? Probably not. They're probably gonna hire, 60, 70% of people that you need to actually run a hotel. And that's actually quite interesting, 60 to 70%. Because the Chinese economy, while it had horrible numbers, the same way as you're seeing horrible numbers from the US, what's quite interesting is that now they're opening up, and if you index, so you make January 100%, so whatever the level of GDP was in January is 100%, then GDP in China right now is at about 62. So you say, oh wow, it dropped about 38 percentage points of its 100 level. Yes, that's true. But this time last year, the economy was not at 100. It was at 80. So you have that gap. It's actually 20 percentage points gap. Why do we have that gap? Because we in Europe start consuming, and that's probably where we have that gap. Now when they start open, what's going to happen with that gap? It's probably going to close a bit. So maybe the gap is going to be 10 points. So we're going to be around 70% of where we were in January, which is also, I guess, the holiday period. Not the holiday period, but it's that time we Westerners buy all these gifts, right? And they are probably producing a lot of those in China. So I reckon we're not going to go back to where we are or where we were, but we're not going to be at these very, 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 very low levels. So what can I do? Well, I can buy here if I wanted to. Stop loss would just go below there. And if I get stopped out, the market declines a bit. And then I would look at the market. If the trend continues to be bearish, then I'm not going to be buying. But if the market starts to turn bullish and I start to get a bullish trend and bullish patterns, then I would look to be buying again. So I have that big picture overview. And that's how I deal with the markets. So how can we trade them safely? Well, you know now what a trend is, and you know as well where you can put them a little bit. Of course, I know I wasn't into all the details, but you know a little bit what a trend is, so you know a little bit of where to put the stop loss orders. You also know a little bit of when to enter in the case of the retracement. You also know when to enter in the case of the breakout. And the only thing we didn't cover actually is the money management. So what can I say about money management? It's actually quite straightforward. When you trade, if you trade short term, most people don't risk more than 1% of their account. What does that mean? Well, if they buy here at the current price is at 10,251 and they put a stop loss just below, then the actual change in the index is 1.5%. However, if the market goes down here 1.5%, the damage in your account should just equal 1%. So you normalize like that. That's when people do trade short term. If you're trading longer term and you're super confident, you can go slightly higher with your risk. if you're investing for your pension and you're not going to retire now, you're going to retire in 5-6 years, then buying and just holding is the way it has worked historically. So then you don't actually deal with that sort of logic. But for anything else, you look to risk about maybe maximum 1.5%, because you can show statistically. So you just put the levels in. So the typical person, he's going to be right 60% of the time. So what you do, you let our software calculate, okay, what happens if I trade 100,000 times and I win 60% of the time and I lose 40% of the time? What's the mathematical likelihood that I'm going to lose like 10 times in a row? And then you sort of figure out a little bit, okay, what's the likelihood of that? It's something like that, but you use random generators, what's called a true random generator, and it gives you these numbers, and it shows that if you start to risk too much, say more than 22%, then what's going to happen is that you will be caught out at one point. Okay, good. So we covered quite a bit. Let's see now if you guys have any questions. And again, this is a short-term and free webinar that we do. If you want to know more, wrong button. I actually offer a free course via ATFX and as well Investing Cube. So Investing Cube, as I told you guys before, that's the site I set up for Investing Cube, or for ATFX, which is the broker, and we have some good deals with them. So we actually do have a Forex trading course, which is up here. And this same course, because I run my own business as well, I used to sell this course for $1,000, £1,000 each. And it's about a 4-hour crash course. Format was of course a little bit different, but it's the same content, but improved. And I used to sell that for $1,000, but we actually sell it now for $7,999. You can get this independently of which broker you trade with, but we do also offer it via ATFX. And the way it works is quite straightforward. You just need to have a real account with ATFX, and then you will actually find it in your account pages. You'll find education, and you'll find things like quarterly market outlooks, and you find this free course. How does that work? Well, effectively happens is that you open up a real account with them, and when you trade, you pay the spread. So depending on which account you're on, if you're like, they have an account that starts at 5,000, and you pay like 0.6 on euro-dollar, for example. So effectively, when you will be trading, let's make it super simple. You pay 1 pip, even though it's 0.6. So when you buy a position for 10,000, they will make $1 on the back of that. And then the idea is that you trade, and you love their services, so you'll continue to trade with them. And that's how this is how this works. So very straightforward. We have this. We also have coaching that we offer, one-to-one coaching. I do recommend that you actually, because you're gonna to have access to the coaching, you can buy that as well for £150 an hour, but you can also get it as well with the ATFX account. So what I do recommend, you watch the course, which I have done, and then we have the coaching. So we don't waste time. You waste time, because we have access to 2 free hours to cover things I cover in the course. But of course, if you already know what you want, you just want more help to deal with stop loss orders, money management, whatever it could be, and you just want to get your questions answered, then we can just do the coaching directly. Okay, let's see about your questions. Let me just log into the YouTube account. And again, sorry for the issues. Okay, so you need to be, okay, I think it's perfectly fine. There's no questions here, and the reason I think for that is because you actually need to be signed in. Okay, so we don't have any questions, which is all good. So we're gonna wrap things up. If you guys are watching this on YouTube, don't forget to like the video, and I hope you enjoyed it. If you do have any questions, let me know. Every day here on the Investing Cube, if you go to webinars, if you click here, you will see my market update, and this is me earlier today talking about the markets, and it's more short-term in nature. I talk a bit about what's moving the markets, and we have the chat box here as well that gives you the opportunity to ask questions. Okay, have a great day, guys. Thanks so much for watching, and I hope to see you guys hopefully already tomorrow. And as well, follow me on Twitter on AlexFX00. Thank you, and bye-bye.